thanks with a grateful heart. Give thanks to the Holy One. Give thanks because He's given Jesus Christ, His Son.
The balance sheet that is our guide for the topics that we cover once we have covered the accounting equation and journal entries for service industries and merchandising concerns. We've talked about cash, we've talked about inventory, out of order in my opinion, and our attention this week is on receivables. It's not that difficult a lesson, and I don't know whether to say things like this to you or not, but I think students make this lesson harder than it should be. And I encourage you to keep it simple. And I encourage you to participate mentally in learning class today and make use of the explanations you hear today. A lot of what you're going to encounter as perceived to be difficult this week, I probably gave you a simple explanation, or at least an explanation for today in class. And I would encourage you to be with me. You have 4 assignments for this week. 3 out of the 4 are on what we call bad debts. And only 1 of the 4 is on notes receivable. With that in mind, I'd like to talk to you about the portion that we're going to talk about most this week. 3 out of 4 assignments on this topic, uncollectible accounts. It's a euphemism. All of the topics this week start with the premise that at the cash register, when we sell an item to a customer on account, that customer appears to be credit worthy. We think it's okay to sell to that customer on account. But we know that from the entire pool of people to whom we sell, we're taking a risk. We're risking that some people won't pay us. Is that any new revelation to you today? Say yes or no. That's a reasonable assumption. I think you just agreed with me. When we extend credit to customers, we know that some of those customers aren't going to pay us. We are faced with 2 possible solutions to that in this week. One of those is notes receivable and interest. And the other of those is uncollectible accounts. I plan to spend most of my time, all of my time today, talking about uncollectible accounts because of the way I set you up. 3 out of 4 homework problems are on that topic, and class discussion kind of parallels that. Later this week, in first discussion in my groups, we're going to talk about notes receivable and interest, and that's one of your homework problems for second discussion. So let's talk about uncollectible accounts, or doubtful accounts, some people call them, or the most common name given for them is simply bad debts. When we extend credit to customers, we know some customers are not going to pay us. How are we going to solve the problem of them not paying us? There are a couple of ways we can do this, and one of them is one of them is 2 of them, actually. That was an awkward sentence. There are 2 possible ways that we can account for this. They are called the allowance method and the direct write-off method. Now, this is not the first time we've faced choices in accounting. We had the choice of asset method and expense method early this semester, and liability method and revenue method, and they both accomplished the same results. We had FIFO and LIFO that didn't accomplish the same results in a period of rising prices. It depended, it mattered which one we chose. And the allowance method and the direct write-off method are not the same. They are distinctly different. And one is considered to be superior to the other. I'd like to introduce you to both of them and provide you the contrast between them. The reason that your handout is duplicated the way it is on purpose is for me to talk about the allowance method from beginning to end. And then we're going to go back and parallel to that, we're going to talk about the direct write-off method from beginning to end. hoping that you and I can compare the two step by step and draw a contrast between them, hoping that you would understand them both better because of this contrast. Let's talk about the allowance method. The allowance method works the way it does because it provides an estimate, an advance provision for an estimate of accounts thought to be uncollectible. When I say that the first time to you, I feel like Charlie Brown's teacher. What did Charlie Brown's teacher say? Wow, 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 wow. To me, that to you should look like gobbledygook. That makes no sense to anybody in the room, I don't think, except me. So what I'd like to do is tell a story to try to illustrate that, and come back in a moment or two and read that to you again and see if it makes better sense the second time you hear it than it did the first time. It makes an advance provision for an estimate of accounts thought to be uncollectible. Let's pretend that we all work for the same company and that someone has prepared this graph of our performance in our company for the past year. These are total sales. What is the explanation for the phenomena you observe on the screen? What's going on here? I heard the right answer. It usually takes 3 or 4 minutes. We may finish on time today. Alexis, what did you say?
Christmas.
Christmas. Most retail establishments, or we could at least say many retail establishments achieve their highest amount of sales at Christmas time. Would you agree? Mm-hmm. Yes. So, agree with me on how many of these sales at Christmas time were on account. I'm going to give you choices of a lot or a few. Pick one. Let's assume, for this illustration, that a lot of the sales we made at Christmas time were on account. So here's the problem. So at the cash register, each of those people seemed credit worthy. You know, with all the stuff we've been through the last 10 years, one of the things that's come up is profiling. Can you imagine the responsibility of a cashier in a store profiling at the cash register to say, yes, you may buy on account, but no, you may not buy on account? Did you hear me just then? At the cash register, each of those customers seems credit worthy. At the cash register, we freely sell on account, thinking that we'll collect from all of them. Yet the premise this chapter is built on is we know we're taking a risk, that some customers won't pay us. So let's say that a lot of people bought from us on account and things are going fine. We're recognizing the revenue that we should in that year. We've always done a good job of collecting at the cash register or selling at the cash register, knowing how much we sold and reporting the revenue. And in January, we mailed statements and some customers began to pay us. In February, we mailed statements and some customers continued to pay us. And then in March, we mailed statements and one of them came back to us, moved, left no forwarding address. And we were busy, and we did nothing about it. And in April, we mailed out statements, and some of our customers paid, but this person had returned the envelope to us, moved, left no forwarding address. Are y'all getting a hint here what's going on? And we were busy, and we didn't do anything about it, and we're slow learners, so sure enough, we mailed out statements the very next month, and one of those statements was returned to us, moved, left no forwarding address. Hello? When are you going to wake up and realize the chances of you collecting this account are becoming more, if you'll pardon the pun, doubtful all the time? It looks as if we run across this particular customer that's not going to pay. So what if we realize it and deal with it and recognize an expense right at that point? We write off this account and say, we're not going to be able to collect that. It's an expense. My question of you is that matching? Yes or no? That's scary. one of the main things you should take away from the course is the goal on the income statement is to match all of the revenue with all of the expenses in that particular time period. Is reporting revenue now and expense later matching? Yes or no? I need a more hearty answer than that, please. Is this matching? Yes or no? No. So that's not good income statement preparation. That's not acceptable. So the solution to this would be to some way, somehow report that expense earlier. Well, we don't know how much. Well, then estimate it. Have we estimated other things this semester? Sure. An estimate is better than ignoring it most of the time. Let's estimate this and report the revenue earlier. Let's read these words again. The allowance method makes an advance provision for an estimate of accounts thought to be uncollectible. Did that make better sense this time than it did before? Yes or no? Yes. What I just explained to you was the rationale behind what we do. What I just explained to you was an income statement benefit. Because we're going to do what we're going to do, both financial statements will be better. Here's the income statement benefit for us doing this. The allowance method is considered to be superior because it makes an advanced provision of the accounts thought to be uncollectible. It provides better matching of expenses against revenue in that particular time period. The income statement is going to be better because we're going to do what we're going to describe today and this week. Well, most adjusting entries that we make have a balance sheet benefit and an income statement benefit. So let's talk about the fib you've been telling on the balance sheet. You've been preparing balance sheets since chapter 1. You've been listing receivables on the balance sheet as if you were going to collect them all. And today, you had an awakening. Are we going to collect it all, class?
No.
The chances are good that we won't collect it all. Yet we've been saying on the balance sheet, we expected to collect it all. Do you see the problem? Yes or no?
Yes.
Well, then let's solve the problem. I don't know what we're not going to collect. At the cash register, they seemed credit worthy. I just know we've got a pretty good chance of not collecting it all. So how about we reduce receivables on the balance sheet to what we think we'll collect? Does this format look familiar? Have you done anything like this on the balance sheet before today? Yes or no?
Yes.
I see heads nodding all over the room. We've used a format like this before. It's a little questionable at the moment. We need to fill in some of the question marks. How are we going to reduce receivables to what we think we'll really collect? Well, first of all, let's establish it as a goal that we're attempting to accomplish. There's an income statement benefit, better matching. There's a balance sheet benefit. It reduces receivables to the amount that we expect to collect. We're going to have a better income statement and a better balance sheet because we accomplish what I'm about to describe to you. So, here's the conclusion. Here's the goal. Here's the target. Here's our objective. This is what we intend to accomplish. How are we going to get there? Well, with many other things that we find out of date on the balance sheet and the income statement, we make adjusting entries. We've learned to adjust supplies, prepaid insurance. We've learned to adjust for depreciation. We've accrued interest. We've done all sorts of adjusting entries. We'll add this to the list. The allowance method makes an estimate at the end of the year, an adjusting entry at the end of the year to accomplish exactly what I just described. That entry is debit bad debts expense. Want to guess what kind of an account it is? Asset, liability, capital, revenue, expense? Say something.
Expense.
It's an expense. Goes on the balance sheet or the income statement? Goes on the income statement. Aha. There's the income statement benefit you heard described in the last few minutes. And then credit an unusually named account allowance for doubtful accounts. Now, I abbreviated it. That first symbol is allowance. A-L-L-O-W-A-N-C-E. Allowance for doubtful accounts. Debit bad debts expense, and credit allowance for doubtful accounts. Well, how about guessing what kind of an account allowance for doubtful accounts is? Can you envision it on the balance sheet? Can you think about what its nature might be? I filled in the question marks. Accounts receivable minus allowance for doubtful accounts. What kind of an account must allowance for doubtful accounts be? Say something. It looks like contra asset, doesn't it? It's contra receivables. So it's one of the many contra accounts we've learned. John Doe drawing was contra revenue. Accumulated depreciation was contra asset, contra equipment. Sales returns, allowances, and sales discounts were contra revenue. Purchases, returns, allowances, and purchase discount were contra expense. And now we've run into another contra asset account. This is contra asset or contra receivables. You can say either. It doesn't matter which way you say it. They tie for first place. Contra asset, contra the whole thing. Contra receivables, contra something specific. What's its normal balance? Debit or credit?
Credit.
Is it closed or not closed? How about bad debts expense? Bad debts expense, closed or not closed? Closed. Allowance for doubtful accounts, closed or not closed? Not closed. It goes on the balance sheet. It's contra receivables. It's contra asset. Is anybody with me right this minute?
Yes.
It's not closed. Yes or no?
Yes.
Good. So, allowance for doubtful accounts is contra receivables, contra asset, contra receivables. You say either. The remaining question is, for how much, why use a contra account at all? Some of you are wondering why we just don't credit accounts receivable right this minute. Any thoughts on that? Aline?
Better tracking so you know an estimate of how much money you're not going to get back.
We can do that someplace else. Zach?
The person may pay the money back, but maybe at a later time.
They may do that anyway, whether we use a contra account or not. That is true, but I don't think that matters to this concern I have.
Because it's not a return.
It's not a return, but we're writing them off the books. We don't want them on the books anymore. Anybody see the problem we have right this minute? Austin?
Normally when credit accounts receivable is when you pay something off, but they're not paying this off.
That's true, but do we want to carry them on the balance sheet any longer? At some point we need to get rid of them and stop calling them an asset. They're not. Why use a contra account to reduce receivables? Why not just credit accounts receivable right this minute? Wesley?
Because we haven't received any money towards the accounts receivable. It's just
That's kind of the same thing I'm hearing refined a little bit. Who in the accounts receivable subsidiary ledger would you post to right this minute? Who is it that's not going to pay us? Do we know?
No.
It's an estimate. That's my point. Do you remember back in the special journals chapter, 2 chapters ago, that when we had a control account and a subsidiary, it was accounts receivable dash customer? We had to post to the control account and post to the subsidiary? Yes? Sound familiar? Well, my question is, if we're using a subsidiary ledger, and we are for accounts receivable, what better place to use a control subsidiary relationship and keep up with what customers owe us? How are we going to post to somebody in particular's account to the subsidiary ledger when it's an estimate? We don't know who's not going to pay. Did you understand the explanation I just gave? Yes or no?
Yes.
We don't know who's not going to pay. So we've got to estimate it in advance, reduce receivables indirectly through allowance for doubtful accounts, and later when we find out who in particular is not going to pay, will solve the problem we just created. This is still a good solution. So, there's one other vocabulary term I'd like you to know. Pretend that what you see in yellow on the screen was equipment and accumulated depreciation. Are you with me right this minute? I asked you whether you'd seen this format before, and you said yes. And I didn't ask what it was, but I'm guessing it was equipment reduced by accumulated depreciation. Could you say, uh-huh? If this were equipment and accumulated depreciation, what name would be given this subtotal? Everybody that knows said? Book value. About 3 people said this is book value. And I'd like you to know that for equipment. I remember the day I got on my knees and begged you to know that every time I asked the question. And you remember that too. But you don't remember book value like I wanted you to. This is not called book value. But a lot of times, what if this were sales and this were sales returns and allowances? What would this be called? This is net sales. A lot of times, when we reduce the main account with its contra, we give the result a name. This one is called cash realizable value or net realizable value. Are you with me? Yes or no? It's just a vocabulary term. It's the equivalent to book value for equipment. But it's called net realizable value or cash realizable value. That's the term we're going to try to use for it. And it's a good term in terms of the objective that we've created. What is the purpose here? If you look back to the 2 reasons that I gave, better matching on the income statement and on the balance sheet, it reduces receivables to what you expect to collect. Cash realizable values, what you really think you're going to get in cash from those receivables. This is the most important journal entry we'll make this week. There are several journal entries we need to learn. None is more important than this one. This is what gets the ball rolling. We're going to have an income statement benefit and a balance sheet benefit because of that. Now the question that remains on this topic is, for how much should the entry be made? And there are 2 ways we could come up with that amount. The amount of the estimate could be based on revenue. If you take an income statement approach in coming up with this estimate, you base it on revenue. It could be based on receivables. If you take a balance sheet approach, you could come up with a good estimate. These are different approaches that you could take. Either one will work and benefit for you. Basing it on revenue is an income statement point of view based on sales or probably net sales. Based on receivables is a balance sheet view. They are good ways to do it depending on how your company wants to work it out best. I'd like to describe that to you and the differences between them with the decision tree I reproduced for you on the front page. That's just where I had space to do it. The difference in the 2 methods is apparent in the first decision. We're contrasting direct write-off method in a few minutes with the allowance method we're in the midst of. It appears the direct write-off method is going to be a whole lot simpler. Wouldn't you agree? The allowance method, which we're choosing to do right this minute, asks the question, how should we come up with the adjusting entry at the end of the year? In order to come up with that amount, the words on the previous slide said we could base it on revenue or we could base it on receivables. That's exactly the point of this decision tree, to draw a contrast. If we base it on revenue, actually what I'm going to do in the next few minutes is describe each of these 4 positions and ask for your help in the description and administering this method. One way to do it, you'd be surprised what business people know. One way to do it would be to base it on total sales. Some percentage times total sales. Are you with me? You ought to know that in your company. You ought to be able to figure it out. What percent am I losing? Some percentage times total sales, multiply it out, make the entry for that much. Debit, bad debts expense, credit allowance for doubtful accounts for that top amount. Now, that's a good way to do it. What's wrong with, or what is the drawback of doing it that way. Who's included in this group that's not part of the problem? Cash customers, I heard the correct answer. You sold to some people for cash, and they're not part of the problem. So how about we eliminate cash customers from this calculation? Narrow our population a bit. That's the second description. It says a percent times sales on account. The cash customers aren't the problem. They paid already. Let's know our percentage in our company and multiply it by the people's balance that we sold on account. That'd get us a better answer. Don't you agree? A slightly more accurate answer, perhaps. Now, let's consider what's wrong with that population. So it was first total sales on account. Now it's just the people, no, total sales on account. Who's in this group that shouldn't be there? Let's eliminate some more people. The people that have already paid. The people that have already paid aren't part of the problem, are they? Now, notice the difference that occurs right here. This was everybody we sold to on account. This is everybody who still owes us. It's at that point in time that we switched points of view. It's not based on revenue anymore. Now it's just based on people that owe us money. Do you see how we narrowed the choice again? Yes or no? And this has the potential of being a better estimate. Again, if we just multiply by the people that owe us money. And there's two possibilities here. Maybe you know that figure in your head. Maybe you know how to work the formula in your company to figure up that percentage. Maybe you've been tracking this for 10 or 15 years and you saw it get a little bit worse last year, and maybe it's a little bit worse this year, but you can get close this way. Some percentage times the balance of accounts receivable. Or the last result here is based on the age. Would you agree with me that the longer that an account is outstanding, the less likely we are to collect it? Is that a reasonable assumption? The people that we sold to yesterday, we're pretty confident that we'll collect. Maybe 99.5%. But the couple that we mailed the statement to and it was returned, moved, left no forwarding address, 3 months in a row, we're not so sure about. The older it gets, the less likely we are to collect it. Agree or don't? Say yes or no. Yes? Well, then what better way to look at how old they are? To age them, to examine each account and have percentages based on your past experience, similar to the ones I just described. Don't write this down, please. Just look at it as the point I'm trying to make. So those accounts that are less than 30 days old, we go multiply by whatever percentage you think. And the ones that are 30 to 60 days old, we're less likely to collect. Only about 85% of those are collected. And then the 90 to 120 days, we're only 50% sure we'll collect. And the ones over 120 days, there's a 25% probability we'll collect. Do you see the point? We would multiply it out for every group and come up with an estimate of what we think is going to be uncollectible. We're being told that result should be the balance of the allowance account. This, perhaps, is the most accurate way to do it. Now, here's the point of the discussion and the decision tree. There's this big blank spot when you base it on revenue, and there's this comment when you base it on receivables. When you base it on revenue, that's an income statement view. You're being told what you want in bad debts expense. When you base it on receivables, that's a balance sheet view. You're being told what you want in the allowance account. It's two different approaches. When you base it on revenue, you simply make the entry for the result of your calculation. When you base it on receivables, you must consider the balance of the allowance account. The allowance account is part of receivables. You don't need to make the entry for the whole thing. You need to adjust the entry that you make based on the balance that's already in the allowance account. It is this contrast, the big blank with no comment, and this comment, consider the balance of the allowance account, that I'm trying to drive home. And again, I feel like Charlie Brown's teacher. I can talk about this all day long, but until I show you what I mean, it's useless to you. I hope to get to an exercise at the end of the hour where I can show you that in the decision that we make, the amount of the adjusting entry. So, an income statement view, a balance sheet view. If it's a balance sheet view, we have to take into account the balance that's in the allowance account. Let's talk about some leftover things we need to do. Under the allowance method, one of the things that's going to happen is that we're going to determine a particular customer is not going to pay. The question comes, how do we write off an account under the allowance method? And every person in the room should know how to do this from logic, not from having read the chapter. You should know the credit. Could I appeal to you to think and respond to me? If you're writing off an account, what should you credit? Say something. I heard a few people say it. Say it a teeny bit louder. If you're writing off an account, what should you credit? It should be accounts receivable, and those of you that didn't see that are wishing you had and said it with the rest of us. Does that make sense? Yes or no? You're writing off an account. Credit accounts receivable. And it's a controlled subsidiary ledger. Now we know one particular customer is not going to pay us. We're going to post to their specific account in the subsidiary ledger and reduce them to zero. They're not an asset anymore. Now here's the contrast, or part of the contrast, between the allowance method that we're in the midst of and the direct write-off method, the other approach. When you're using this method, you've already reduced accounts receivable once indirectly through the allowance account. Now you're reducing accounts receivable again. That seems like double dipping, and it is. We don't need the reduction in allowance for doubtful accounts anymore. When you write off an account under the allowance method, you debit the allowance account. This provision that you made in advance, you anticipated that this would happen. And you're not reducing it using the allowance account anymore. You're reducing it by crediting accounts receivable directly. When you write off an account, you debit allowance for doubtful accounts and credit accounts receivable. My least favorite part of this talk is the last part I'm going to cover here. It is, what happens if that customer pays us? Well, first of all, woohoo! This is great. We're excited, we're thrilled, but I just think you could figure out this and me not take class time to explain it to you. When you collect cash from this customer, debit cash, you would normally credit accounts receivable, but oops, you wrote it off already. There's no accounts receivable to credit. Y'all with me here? So if they pay you, praise the Lord. But you've got to put their account back on the books. This is one of those look back things. Look where you wrote it off and reinstate their account. You got to get their account back on the books so that you can record the cash collection in the usual way. Put their account back on the books, or at least the portion that they just paid you, the collection. And then record the cash as you normally would in the cash receipts journal, perhaps. You would debit cash and credit accounts receivable. Now that one is probably the simplest thing we're going to do this week. Let's concentrate on the meat and not dwell on this one. That ends my discussion on the allowance method. I would like to begin again and talk to you about the direct write-off method. It's much simpler. Probably the best rationale for picking this method is simplicity. And we're going to see that. It won't take us near as long to get through this one. The direct write-off method recognizes an expense at the time we determine a customer's not going to pay us. You should, because these are side by side, contrast them as you go along. A minute ago, on the left side, the allowance method said, we made an advance provision for an estimate of those accounts thought to be uncollectible. This makes no advance provision. This one writes off the account at the time we determine the customer's not going to pay. In fact, we've seen a picture of this today. When we talked about this graph and reporting revenue now and expense later when we determined that they weren't going to pay, that is the direct write-off method. That is potentially what happens under the direct write-off method. Now, There is no deliberate matching here. There's no attempt to match as there is in the allowance. Some matching could occur by accident. We could sell something in February and write them off in May. We could have them in the same year, but that'd be an accident. That wouldn't be planned as the allowance method does. Under the direct write-off method, we write off the expense when we think it's uncollectible. The advantage to this, I've already mentioned. It's simpler than the other. That's why a lot of companies pick it. That's unfortunate. They just don't want to fool with it. Larger companies are going to do it the right way. A minute ago, we looked over on the left side to see how the allowance method accomplished this, and it made an adjusting entry at the end of the year. The direct write-off method is not attempting to make that advanced provision. There is no such adjusting entry. A minute ago, we were concerned with how to come up with the estimate. If you look over on the left side, it says we base the estimate on revenue, an income statement approach, or receivables, a balance sheet approach. If there's no adjusting entry at the end of the year, there's no need to have an estimate. We don't do that. A minute ago, under the allowance method, we were talking about how to write off an account. And under the direct write-off method, we still need to write off accounts. When we determine a particular customer is not going to pay, we're going to write off their account. If you know what to credit, and you should, if you know what to credit in this entry, would you say it right now? When you write off an account, you credit accounts receivable. Does that sound familiar? That's the same way we did it under the allowance method. That part is the same. When you write off an account under the allowance method, when you write off an account under the direct write-off method, you credit accounts receivable. That part's the same. Look over on the left side. When you write off an account under the allowance method, you debit the allowance account. When you write off an account under the direct write-off method, you debit bad debts expense. Do you see the contrast I wanted you to see? Say yes or no. Yes. The difference between these two methods is big, but here's one of the significant ones. No estimate, no adjusting entry. When you write off an account, here's how you do it. You debit bad debts expense. There's where it gets its name. No allowance account, no estimate. When you write it off directly to the expense account at that moment. The direct write-off method. Did you hear it? That's how it gets its name. So, perhaps this customer pays you. If this customer pays you, then we need to put their account back on the books. That'd be a good time to look back and see how you wrote it off. You debit accounts receivable. They owe you again. And credit bad debts expense this time because that's the opposite of what you did when you wrote it off. And then you can record the cash collection the same way that you always do. In the cash receipts journal, you would debit cash and credit accounts receivable to record that they paid you and no longer owe you. Allowance method, direct write-off method. Allowance method is considered to be superior to the direct write-off method. You ought to know why. Let's work an exercise in the time that remains and see if I can't demonstrate to you the point of the decision tree we saw. The approaches based on revenue, based on receivables, for how much should the adjusting entry be made. That's the point of this little exercise that we're going to do together. The ledger of our company at the end of the current year shows accounts receivable $90,000, sales $840,000, sales returns and allowances $40,000. If allowance for doubtful accounts has a credit balance of $800, would that be normal or abnormal? Say something. Speak up.
No.
That's normal. Allowance for doubtful accounts is contra receivables. It should have a credit balance. Journalize the adjusting entry at December 31st, assuming bad debts are expected to be 1% of net sales. I'm hoping that at some point I can ask you and you could fluently say to me, the adjusting entry at the end of the year is debit bad debts expense, credit allowance for doubtful accounts. When that entry was on the screen a few minutes ago, I said we're going to learn a lot of entries, several entries, 3 or 4 entries this week, but none is more important than this one. This is the driver. This is the one that gets the whole thing started. This is the story I told you. My objective was to tell you 2 illustrations, 2 advantages, an income statement advantage, a balance sheet advantage, that would allow you to recall this entry without memorizing it. What are you trying to accomplish? You want to match the expense with that year. Debit bad debts expense. Reduce receivables to what you think you're going to collect. Credit allowance for doubtful accounts. That's the most important entry we're going to make this week. And the amount of this entry is the question, the point of this exercise. If we finish it, we'll have done 4 circumstances, 4 situations. Every one of them, debit bad debts expense and credit allowance for doubtful accounts. Each of them will be for a different amount depending upon the circumstances that we're doing. All of these will have this same entry. Now, the problem says sales are $840,000, sales returns and allowances are $40,000, and our estimate is 1% of net sales. You can do net sales in your head. What are net sales? The amount? Say it. 840 minus 40 is 800,000. How about doing 800,000 times 1% in your head? What'd you get? 800? 80,000? 8,000? It's 8,000. 1% of 800,000 net sales is 8,000. Now, in this, there's a professor that used to teach here that said he became a better student when he learned to think like the teacher. He was describing his PhD program, but it applies to other levels of your learning. I'm going to lead you through determining possible multiple choices, and it occurred to me that the better you understand the other choices, the better able you're going to be able to get the right choice. Start to think like the teacher. How are we going to ask you about this question? Well, here's a good possibility. 1% of net sales. But there was an allowance account. The allowance account had a balance of $800 credit. Remember that? Remember that? Then let's add 800 to this and get a choice. And subtract 800 from this and get a choice. And declare the right answers on the screen. Now I know it's early. We could view this as pre-test and the final exam as post-test. Did y'all understand what I just said? It's okay if a bunch of people miss it today. What would work best today is if I had clickers. This is a perfect application of clickers in this class, in my opinion. Every one of you vote. And we could see that perhaps a lot of people missed this first one. We could learn from it, and a few more people got the second one right, and a few more people got the third one right, and a whole bunch of people got the fourth one right. Wouldn't that be nice before you left the room today? That's my goal. But I can only get that goal if you'll participate. And I'm stalling right now to allow you time to choose one of these. Don't look at your neighbor. Don't look at the way they vote. Just vote. I need a whole bunch of people to vote on one of these choices. If you think the right answer is 8,800, hold your hand up real high. If you think the right answer is 8,000, put your hand up real high. If you think 7,200 is the right answer, put your hand up real high. More people picked this one than any of the others. But some people picked them all, and I've got a feeling a whole lot of people didn't vote. And you'll learn more, I promise, if you'll try. Okay, you need to vote. The right answer is 8,000. And you might have guessed and gotten it right, so don't boast to yourself and get all full of pride because you guessed right. Let's see if we can figure out why 8,000 is the best answer. What was the key to this one? It was based on sales. On the decision tree early this hour, when it was based on sales, that's revenue. We made a calculation and we just made the entry for that much. It's an income statement view. Is allowance for doubtful accounts on the income statement? This is the key right here. Listen, this is it. Is allowance for doubtful accounts on the income statement? Yes or no? If this is an income statement view based on revenue, then you don't look at the allowance account. The allowance account has nothing to do with this. You just make the entry for that much. The answer is $8,000. It was based on revenue. Now, your problem says if instead of basing it on revenue, it had been based on an estimate of receivables, 10% of receivables. Let's read the paragraph. At the end of the year, accounts receivable had a balance of 90. 90,000 times 10% is 9,000. So let's come up with some good choices here. We're going to debit bad debts expense and credit allowance for doubtful accounts every time. In this case, the amount of that entry is 10% of receivables. Perhaps that is this 9,000. The allowance account had an $800 credit balance. I added $800 and got $9,800. I subtracted $800 and got $8,200. Do you see how I got the three choices? Say yes or no. Yes. I'm stalling to allow you time to pick the right one. I'm hoping you'll vote. There is no pain in you missing this today. In fact, there is the potential to gain from missing it today. Are you ready to vote? Say yes or no. The right answer is on the screen. Do you think you might have to make this decision sometime soon? Yes? If you think the right answer is 9,800, put your hand up real high. If you think the right answer is 9,000, put your hand up real high. If you think the answer is 8,200, put your hand up real high. Nobody picked the first one. A few people picked this one. The most people picked this one. The answer is 8,200. How did we come up with this estimate? It was based on receivables. When you base it on receivables, 10% of receivables, then that's a different approach. What kind of an account is the allowance account? Contra asset or contra receivables. How can you look at receivables and analyze them without considering a big, huge part of receivables, that being the allowance account? So the worst answer was the one that most people picked. It was either add the balance or subtract the balance, and because it was a credit balance, we're saying there's already 800 in that account. We only need to add 8,200 to it. Now what will the balance of the allowance account be? Come on, speak up. If the balance of the allowance account was 800 and we just credited it for 8,200, its balance will be 9,000. And that's what we want it to be. 10% of receivables was $9,000. We got it to be what it should. You make the entry and consider the balance of the allowance account. You have to take into account what's already there.
The third of these four examples is labeled letter B. We still have some of the same characteristics. Accounts receivables balance is $90,000, sales $840, and sales returns and allowance is $40. But letter B makes a change in the allowance account itself. In letter A, it had a credit balance. In this case, it has a debit balance of $500. A debit balance is abnormal. Allowance for doubtful accounts is a contra asset account. Its normal balance would be credit. So one of the questions that should be entertained is, why would it have a debit balance? Well, two good, quick, reasonable answers would be, one, we missed our estimate, or two, perhaps we've written off some accounts during this year before we made this adjusting entry which we're about to make. If we've debited this account to write off accounts before we credit the account to make the provision for all the bad debts we thought we would have, it could possibly have a debit balance. Then the instructions are, journalize the adjusting entry assuming bad debts are expected to be 0.75% of net sales. As you know, net sales are $800,000. 840 minus 40. 0.75% of net sales would be $6,000. $800,000 times 0.75%. So we should consider the two other possibilities, adding the balance of the allowance account and getting $6,500, or subtracting the balance of the allowance account and getting $5,500. As the two situations before, the right answer is on the screen. It's either $5,500, $6,000, or $6,500. Debit bad debts expense, credit allowance for doubtful accounts for one of these three numbers. Why don't you choose? I'll pause a moment and give you an opportunity. Pick one of those answers. In class, I would have had all who thought it was $5,500 raise their hands, and then all who thought it was $6,000 raise their hands, and all who thought it was $6,500, and so forth. And hopefully we would see improvement over the previous two answers we've given. The right answer in this case is $6,000. $6,000 is the right answer because it was based on revenue. The amount of the calculation was 0.75% of net sales. If it's based on revenue, you simply make the entry for that much. If it's based on revenue, it's an income statement approach, and you're being told what you want in bad debts expense. Bad debts expense didn't have anything in it before, so we would want to make the entry for that amount. It's an income statement view. When it's based on receivables, we consider the balance of the allowance account. When it's based on revenue, we simply make the entry for that much.
And let's do the receivables one really quick and see if we can get you to get the right answer on that. Here it is, 8% of receivables. 8% of 90,000 is 7,200. Is that true or false? True. 7,200 plus the balance of the allowance account. I went too fast. The balance of the allowance account changed to a debit. How much is it? $500 debit. Is that what it says? $500 debit. So I'm going to add 7,200 and 500, the balance of the allowance account, and get this. I'm going to subtract the balance of the allowance account and get this. Let's vote. I'll tell you the right answer, and we'll go. If you think the right answer is 6,700, raise your hand. If you think the right answer is 7,200, raise your hand. Good. Not one person picked that. Every person in the room realizes it's one of these two. If you think it's 7,700, raise your hand. Wow, I wish you could stand right here and see that. That's the correct answer. You've gone from a whole bunch of people missing it to a whole bunch of people getting it right. Why is the right answer 7,700? Because you got to compensate for that debit balance. You want the balance to be 7,200 when you're finished. It takes a $7,700 entry to accomplish that. That's exactly like your first homework assignment. And have a great day this week, a great week this week.